And today, we're going to break the myths that have been guiding wrong financial decisions for decades. We'll talk about something many consider an absolute truth. Real estate prices always go up. Is that really true? Well, many people blindly trusted this advice, invested at the peak of the market, and ended up deeply regretting it. Imagine this. You hear that friend or even your real estate agent saying with great conviction, "Oh, buy now, the price will only go up." And you, afraid of missing an opportunity, close the deal. But soon you find out that you paid too much and that prices started to fall. New buildings being constructed, the supply increasing, and suddenly the property you thought was a safe investment turns into a headache. The real estate market is not a road that only goes up. It has its ups and downs, just like any other market. And do you know who suffers the most from this? The people who make hasty decisions, believing in simplistic promises like real estate is always a good investment. The problem isn't just buying, but buying without understanding the market's timing. So, before jumping on the idea that real estate always appreciates, it's important to stop, analyze, and remember. No bubble lasts forever. When you hear stories of people who lost everything, it's often because they trusted this myth too much. This brings us to the next point, the impact of inflation on society. Have you ever stopped to think how inflation doesn't affect everyone the same way? While some see their assets appreciating, others struggle to pay their bills each month. Robert Kiyosaki, author of the famous book Rich Dad, Poor Dad, has always been very clear about how inflation affects different social classes. For him, inflation is not just an invisible enemy for the poor, but also a tool that benefits those who already have much. What Kiyosaki observes is that while the rich have assets that appreciate over time, such as real estate and stocks, the poor and middle class increasingly rely on wages, which are severely eroded by inflation. When he talks about inflation, Kiyosaki is warning about how it penalizes those who lack proper financial education. The middle class, for instance, feels the impact of higher prices because their wages don't keep up with the cost of living. This means that to maintain the same standard of living, families need to work harder while the money they have loses purchasing power. On the other hand, the rich manage to protect themselves from inflation. They own assets like real estate and businesses that appreciate as the cost of living increases. For Kiyosaki, this is one of the great lessons of his philosophy. Invest in assets that grow over time, not liabilities that just create expenses. He always emphasizes that, while the poor and middle class struggle to pay their bills, the rich invest, make money, and make their money work for them. Kiyosaki also criticizes the current tax system, which tends to be much heavier for the middle class and the poor, while favoring the wealthier. He points out how high taxes are often a reflection of inflation. The government needs to raise money, and for that, taxes on middle class and poor citizens go up. The system, according to him, is designed to keep the rich richer and the lower classes in constant financial struggle. So the question Kiyosaki raises is, why continue following a path that only makes us work more and more without improving our financial situation? The key, according to him, is financial education, learning how to invest and how to make money work for you, not the other way around. He warns that without this knowledge, inflation will continue to be an increasingly heavy burden for those who don't know how to protect themselves. This brings us to the point of how energy policies, such as the closing of pipelines or changes in the oil sector, also directly affect everyone's pocket, especially those who feel the impact of rising inflation the most. When we talk about financial crises, it's impossible not to remember the 2008 crisis, which was a turning point in global economic history. Robert Kiyosaki, in his various publications and interviews, has always warned about the dangers of a false sense of security in the financial market, especially when everything seems to be going well. He's always said that overconfidence in a stable economy is one of the biggest mistakes any investor can make. In 2008, the market was booming. People believed that real estate prices would never fall and that the economy was in a cycle of eternal prosperity. However, when the housing bubble burst, markets collapsed, and the crisis deeply affected millions of people, from investors to families who lost their homes. What Kiyosaki always highlighted, and what many ignored, is that this crisis wasn't an isolated accident, but a natural consequence of a financial system based on easy credit and growing debt. For Kiyosaki, the 2008 crisis was just a reflection of a much bigger problem: the lack of financial education. He explained that many people found themselves on the streets, not knowing what to do, because they were living according to a false sense of security. They trusted the system, believed that real estate was a safe bet, and accumulated debt thinking that real estate and stocks would always go up. The big lesson Kiyosaki always brought up after 2008 is that in times of crisis, those who understand economic fundamentals and own real assets like real estate or precious metals are the ones who come out on top. While the financial system and banks crash, these people manage to survive and even prosper because they are outside the speculative game. At the same time, he warns that in moments of crisis, many fall into the trap of looking for quick and improvised solutions, like selling properties for a fraction of their value or making impulsive decisions based on fear. He also compares the 2008 crisis to other economic downturns, such as the Great Depression. Kiyosaki states that, although the economy goes through cycles of expansion and recession, the true key to surviving these turbulent times is preparing for the worst. He always talks about the importance of a long-term mindset, which includes building alternative income sources, investing in financial education, and most importantly, avoiding excessive debt. For him, the 2008 crisis was a warning that at any moment a collapse can happen, and the only way to protect yourself is to have a well-structured plan for uncertain times. So looking at today's world, Kiyosaki reminds us not to fall into the temptation of thinking that things will get better on their own, or that the market is immune to further crises. He points to the importance of always staying informed, understanding the economic cycle, and most importantly, making smarter financial choices. Only then, he believes, can we avoid the mistakes thousands made before and ensure a safer financial future. Now let's talk about one of the biggest changes in the global economic system, the decoupling of the dollar from the gold standard in 1971. Once again, Robert Kiyosaki emphasizes the importance of this historical moment and the impact it had on the modern economy. When President Richard Nixon decided to abandon the gold standard, the dollar ceased to be backed by physical gold and became a fiat currency. In other words, the value of the dollar began to depend on the trust of people and the government, rather than a tangible reserve of gold. For Kiyosaki, this was the starting point for the current financial situation we find ourselves in, characterized by money printing without real backing and a growing global debt. Over decades, the US government has issued dollars without the need for a physical reserve, leading to an unprecedented monetary expansion. For Kiyosaki, this fundamental change opened the door to an economic system based on consumption and debt, rather than production and savings. He has always emphasized that the real consequence of this is the increase in social inequalities and the creation of an economic bubble that could burst at any time. The problem, according to Kiyosaki, is that people still haven't fully realized the impact of this change. When the government can simply print more money, it leads to inflation, and inflation erodes the purchasing power of the population, especially the middle and lower classes. The value of money is diluted, and at the same time, the prices of goods and services rise. This puts people in a constant race to try to maintain their standard of living, without understanding that true wealth is not about how much money you have, but how you invest in assets that hold their value and grow over time. For example, real estate and gold, for Kiyosaki, are assets that truly protect wealth. Real estate is an excellent way to preserve capital during times of inflation, while gold has historically been a store of value during periods of economic crisis. He always recommends that instead of relying on paper assets such as stocks and currencies, you should invest in something with intrinsic and tangible value. This decoupling of the dollar from gold also had direct implications on the credit market. With the possibility of issuing money virtually without limit, governments and banks began offering credit more easily. This resulted in a culture of consumption, where people no longer needed to save to buy a house or a car, for example. They simply financed their purchases. Kiyosaki, however, warns that this creates a false sense of wealth. When you buy things with borrowed money, you are not really creating wealth. You are simply deferring the bill to the future. For this reason, he always argues that the current monetary system, which relies on credit and money printing without backing, is doomed to create a financial bubble. The risk, according to him, is that this bubble could burst at any time, and those who have not prepared adequately, whether by investing in real assets or creating alternative sources of income, will be caught off guard. In summary, for Kiyosaki, the decoupling of the dollar from the gold standard was a turning point in world economic history. He believes that this triggered a series of negative consequences, particularly regarding inflation and rising debt. For him, the key to financial protection lies in understanding these changes and investing intelligently, rather than following the crowd and falling into the traps of the system. Now let's talk about a concept that might sound a bit technical, but has direct implications on how we deal with the economy and consequently our personal finances. Quantitative easing, QE, and quantitative tightening, QT. These terms, often discussed in the financial market, are explained by Robert Kiyosaki in a simple way so anyone can understand the impact these policies have on our lives. Quantitative easing is a monetary policy adopted by central banks, especially the Federal Reserve, Fed, in the United States, to stimulate the economy. In simple terms, it's when the central bank prints more money and uses that money to buy financial assets, such as government bonds and other investments, with the aim of increasing the amount of money in circulation and thus stimulating consumption and investment. Kiyosaki often discusses the effects of this practice, mainly in how it inflates the prices of assets such as real estate, stocks, and other investments. When the government prints money, the prices of these assets tend to rise. This happens because, with more money circulating, the demand for these assets increases, which drives up their prices. For those who already own real estate or stocks, this can be good, as the value of their assets tends to increase. However, for those who do not own these assets, this is an unfavorable situation. With more money circulating, the cost of living increases, and people who do not have access to these assets end up seeing the value of their salaries decrease while prices rise. Kiyosaki calls this the market distortion. He argues that although QE seems like a temporary solution to stimulate the economy, it ends up creating a bubble where asset prices become unsustainable and disconnected from reality. This ultimately leads to great inequality, where the rich benefit from the increase in their assets, while the poor and the middle class fall behind, unable to keep up with ever-rising prices. Now we have quantitative tightening, QT, which is the opposite. While QE is an attempt to increase the amount of money in circulation, QT is an attempt to reduce that amount. When the central bank implements QT, it starts selling the assets it bought during QE, removing money from the economy. This can lead to an economic slowdown as there is less money available for consumption and investment. When QT is implemented, asset prices may fall, and people may start to feel the impact of a tighter economy. Kiyosaki is very clear about the effects of this process. He believes that QT could trigger a recession. Real estate and stock prices could fall, which harms those trying to sell or who bought assets at inflated prices. At the same time, the cost of credit rises, as banks have less money to lend. This makes it more difficult for people to take out loans to buy homes, cars, or even finance their businesses. Kiyosaki warns that the real problem arises when the QE and QT policies become a vicious cycle. During QE, asset prices rise, creating a financial bubble. When the central bank decides to implement QT, this bubble begins to burst, leading to an economic crisis. For him, the solution is not to wait for these monetary policies to be implemented, but to learn how to navigate these economic fluctuations and invest wisely, so you're not caught off guard when the bubble bursts. Ultimately, Kiyosaki recommends that during QE times, people invest in real assets, such as real estate and gold, which tend to appreciate when there is an increase in the amount of money in circulation. On the other hand, he suggests caution when QT comes into play, as the market may begin to slow down and prices may fall. For Kiyosaki, the most important thing is to understand how these policies affect the market and, based on that understanding, make financial decisions that protect your wealth in the long term. This cycle of QE and QT is just a reflection of how the modern monetary system works, and Kiyosaki makes it clear that to navigate these ups and downs, financial education is key. Knowing how these policies influence the market and what to do at each moment can be the difference between losing money and building a solid financial foundation for the future. Now let's talk about a topic that is at the heart of current financial discussions: the growing dependence of the global economy on credit. Robert Kiyosaki has been talking about this for years, highlighting how the economic system has gradually been shaped to depend more and more on credit and less on savings. What happened over the past few decades, according to Kiyosaki, was a significant shift in the economic behavior of people and businesses. In the past, economies were built on saving and investing. People saved part of their salary to ensure a comfortable retirement or to make big purchases like a house or a car. Businesses, in turn, used their own capital to finance their growth and expansion. But this changed drastically over time, especially after the 1970s. The credit system expanded more and more, allowing people and businesses to live beyond their means. Instead of saving to buy durable goods, people began using credit, taking loans to finance their consumption dreams. Kiyosaki points out that today, most of the global economy revolves around financed consumption. This is reflected, for example, in the rising prices of real estate. Many people buy their homes with mortgages without actually having the full amount available in savings. They buy now and pay over many years. However, this system also has a downside. When people start relying on credit for everything, from buying a home to purchasing everyday items, they become increasingly indebted. And debt, in the end, has to be paid off. Easy credit creates a false sense of wealth, but deep down, it's a ticking time bomb. The dependence on credit also has a direct impact on businesses. Many of them don't have enough financial reserves to grow without resorting to loans. This creates constant pressure to keep taking on more debt, which can be very risky when economic conditions begin to change. For Kiyosaki, businesses and individuals who don't have tangible wealth reserves, like real estate or gold, become vulnerable when credit becomes more expensive or scarce. And this is exactly what worries Kiyosaki. He believes we are in a situation where the economy is supported by a house of cards. Credit upon credit. The The moment of fragility is always imminent, especially when interest rates rise or credit becomes harder to obtain. In this scenario, those who are unprepared, those who don't have real assets and rely on debt to finance their dreams, are the ones who suffer the most. He advises his followers to start changing their mindset. Instead of living off credit, it's time to invest in real assets that can generate positive cash flow, like rental properties, businesses, and commodities like gold. This helps protect against market fluctuations and ensures a stronger financial base. For Kiyosaki, true wealth doesn't come from immediate consumption and easy credit, but from building assets that generate passive income and protect against inflation and market risks. In summary, Kiyosaki sees dependence on credit as one of the biggest traps in the modern economy. He always emphasizes the importance of understanding this system and starting to invest in real assets to avoid the debt trap. When people become more aware of this dependence on credit and begin building a more solid financial foundation, they can protect themselves from the risks of a consumption and debt-driven economy. Now, let's explore a crucial topic that lies at the heart of Robert Kiyosaki's concerns: the traditional retirement system, especially the 401k model. Kiyosaki has been very critical of what he sees as a flawed system that could be dangerous for those relying on it for retirement. He believes the 401k and similar systems based on stock market investments are not safe or reliable solutions to guarantee a peaceful retirement. First, let's understand what the 401k is. This is a retirement plan offered by most companies in the United States, where employees can invest a portion of their salary into a fund, which will be used for retirement. Many companies offer some kind of additional contribution, which may seem like an advantage. However, Kiyosaki points out an important issue. These retirement plans are directly affected by financial market fluctuations. When the market is up, the invested value may grow, but when there's a market downturn, the 401k balance can drop drastically. And if you're about to retire during a financial crisis, this could mean a huge loss. The problem, according to Kiyosaki, is that many people have no control over where their money is being invested. They rely on pension funds or plans managed by banks and investment companies without fully understanding where their money is going. What's even more dangerous, he says, is that these people believe they are building a secure foundation for their retirement, when in reality, they may just be playing a risky game with their future. Kiyosaki criticizes the fact that the 401k is actually a system that favors the stock market and other forms of volatile investments. For him, this means the traditional retirement system doesn't offer the security people think it does. Market fluctuations, management fees, and economic instability can harm those who depend on these plans. Additionally, he warns about the high taxes that may apply to withdrawals from these funds at retirement, which further diminishes the real value of what was invested. Instead of relying on systems like the 401k, Kiyosaki suggests people consider safer and more controllable alternatives for retirement. He recommends investing in real assets, such as real estate, gold, and other tangible investments that tend to withstand market volatility better. He emphasizes that the key to a secure retirement is not relying on a system that is out of your control, but building a diversified portfolio of assets that can generate passive cash flow. For Kiyosaki, the biggest problem with the 401k is the false sense of security it provides. He believes that to ensure a comfortable retirement, people need to take control of their finances and make smarter choices about where to invest their money. Instead of relying on funds that can be affected by market volatility, he suggests focusing on investments that can generate passive income, like rental properties, and seeking assets that can protect them from inflation and market risks. Finally, Kiyosaki warns that to guarantee a stable financial future, it's essential to think outside the box and not blindly follow the traditional retirement model. He encourages his followers to seek financial education, understand the market, and invest wisely so they can achieve true financial independence without relying on risky retirement plans or systems that don't offer the guarantees many think they do. Now, let's address a highly relevant topic in the current financial landscape, especially for those who are paying attention to economic fluctuations and what may lie ahead: the forecast of imminent declines in the stock market. Robert Kiyosaki, in various interviews and books, has spoken about the risks associated with the current economic environment, warning of potential stock market declines that could further harm those who depend on this type of investment to secure their future. Kiyosaki has always emphasized that while people may see the stock market as a way to get rich, the market is far from being a safe solution for long-term growth. According to him, the stock market is volatile, and major crashes can happen at any time, with no prior warning. For Kiyosaki, relying solely on the stock market to guarantee a peaceful retirement or to build wealth can be extremely risky. In particular, he points to monetary tightening and rising interest rates as factors that could trigger a stock market decline. When governments raise interest rates, the cost of credit goes up. This directly impacts the behavior of businesses and consumers. Businesses, which depend on cheap credit to finance their expansion, may find it difficult to grow, affecting profits. Additionally, consumers who have gone into debt to maintain their standard of living may start cutting back on spending, reducing consumption, and further affecting the economy. Another point Kiyosaki highlights is that the stock market is currently being supported by an inflationary bubble fueled by economic stimulus policies like quantitative easing. When credit is easy and money is injected into the system, the stock market tends to rise. However, this rise may be artificial, and a correction or decline may happen as soon as the stimulus cycle is interrupted, or when economic conditions become unsustainable. For him, many investors are ignoring warning signs and entering the market with the false impression that growth will continue. Kiyosaki also warns against blindly trusting traditional financial advice, which often encourages people to keep investing in the stock market even when signs of a decline are evident. He recommends that, instead of following this approach, people seek safer and more tangible investment alternatives, such as real estate, gold, and other forms of assets that can generate passive cash flow and better withstand an economic crisis. He suggests that investors prepare for market volatility and not let greed blind them to the risks. Instead of seeking quick profits and risking it all in highly speculative markets, Kiyosaki advocates for a more focused investment strategy aimed at building real assets like rental properties and precious metals. For him, these types of investments offer greater security, especially during times of economic instability. Therefore, Kiyosaki's message about imminent declines in the stock market is clear. The market is unpredictable, and those who depend on it to secure their financial future could be caught by surprise. He advises his followers to prepare for market risks and diversify their investments into tangible assets that generate passive income. The secret, according to Kiyosaki, is not to wait for the stock market to keep rising indefinitely, but to create a solid and resilient financial foundation that can withstand economic fluctuations and the imminent declines in the market. And thus, we reach the end of another chapter on what lies ahead in the financial market and what Robert Kiyosaki has taught us about how to protect ourselves from economic risks. The truth is that in the current scenario, volatility and warning signs are more evident than ever. The stock market, inflation, and economic policies can have profound and often unexpected impacts. Kiyosaki has shown us that we cannot rely on traditional systems, and that it's essential to diversify our investments and prepare for any scenario. Now I want to know from you, what do you think will happen in the market? Will we witness a significant decline in the coming years, or will the market recover and continue growing like before? I would love to hear your opinion. And don't forget to like this video and subscribe to the channel. This way, you'll always stay updated on everything happening in the world of finance and learn how to protect yourself from any crisis that may arise. See you next time.